Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Riiv to receive the top 10 stocks to buy right now. Netflix reported earnings this week, and investors saw a lot that they liked, including more than 7 million subscribers being added to the service, and the narrative that Netflix is losing customers kind of falling by the wayside. But there was one really concerning trend that did pop up in the earnings results that I actually haven't seen anybody talking about right now, and that is the company's pricing power. So I want to go through exactly why I think we should be a little bit concerned about pricing power and gross margins in the future. My name is Travis Hoium. Thank you for watching Riiv Investing. Please subscribe here on YouTube for more investing insights. I will be back on an almost daily basis here. So let's go over a few of these numbers. And I'm not going to look at these compared to analyst estimates. I want to look at the numbers compared to what was the business doing a year ago and what are the trends over the last year and the last quarter. This is Netflix's statement of operations, so their income statement. You can see here that revenue is up slightly, $7.7 billion a year ago, $7.82 billion last quarter, actually slightly down from the third quarter of 2022, so keep that in mind. Operating income is the other one to look at. Operating income, $550 million last quarter, down from $631 million a year ago, and $1.5 billion last quarter. So operating income is on the decline. As a result, net income is down as well, $55.3 million from $607.4 million a year ago. So investors are happy that subscriber growth is back, but the trade-off here is that Netflix is doing far worse on the bottom line. So what is the reason for that? What you see here is Netflix breakdown of their regional results. So they have revenue, paid memberships, and then net additions to their paid memberships. This is the United States and Canada. You can see here that the numbers are pretty solid. Revenue is down slightly last quarter. That was because of a slight drop in average revenue per membership. That's likely from people either downgrading after price increases or going to that ad-supported tier. Paid net addition, 0.91 million. Not a huge number, but decent for a very mature market like the US and Canada. Growth from a revenue perspective was 10%, but you can see that that was also almost entirely driven by price increases from $14.78 per subscriber a year ago to $16.23 last quarter. But as we go around the world, the numbers change a little bit. You can see in Europe, the Middle East, and Africa, the subscriber numbers were really good last quarter, 3.2 million additions, but pricing is going the wrong direction, $10.81 to $10.43. Now, there is currency impacts here, and so that is important to keep in mind. What Netflix gives us is the currency neutral growth rate from a year ago. So while the year-over-year revenue growth is negative 10%, on a currency neutral basis, it's 5%. That's kind of the positive spin that they want to put on this. That's something that companies often do. One of the reasons that I want to question that is Netflix is being paid in local currencies. If they're producing content and paying their employees in US dollars, it doesn't matter if there's currency impacts or not. If they can't raise prices in those local currencies, they're actually getting a reduction in revenue. That means they have less pricing power than you might think. Go down to Latin America and you see a similar trend. $8.58 a quarter ago, $8.30 last quarter. The impact was 1.8 million additions. But again, year-over-year growth from a revenue basis was only 2% and 7% on a constant currency basis. Asia Pacific was really the shocker here. Year-over-year growth, negative 17% on a revenue basis, despite adding 1.8 million customers. Look at this price decline. $9.26 a year ago for a membership, $7.69 right now. Even on a constant currency basis, Netflix said that its revenue was down 4% year over year. I think what we're very clearly seeing here is that Netflix was having trouble both raising prices and increasing their customer base. So they had to make a choice. Do we want to have a higher price and a higher margin product that maybe has fewer customers, or do we want to keep growing that customer base but give up some margin as a result? They have clearly chosen to give up margin and profitability in the pursuit of a higher customer base. The market seems very happy about that. But as investors, I do think we need to think about how much pricing power does Netflix actually have in the market. You can see here that prices have actually dropped pretty significantly around the world. And in mature markets like the US, where prices are going up, Netflix has actually had trouble adding customers at a really reasonable rate. So what kind of a premium do we want to pay for this stock? That's a really hard question to answer right now because Netflix profitability is significantly lower than it was a year ago. At the close of trading on Friday, shares are trading for $342.50. Earnings in the last quarter were $9.95. That means that the price to earnings multiple for this company is about 35 times. Well, look at the earnings trend. A year ago, earnings were $11.24 per share. So earnings are actually going down despite the fact that the company is increasing their customer base. This is something that should be concerning for investors, and at least put it in your mental model when you think about a stock like Netflix. It's great to be growing, but if you're not able to grow profitably, then it's not going to be great for the business and the stock long term. What do you think about Netflix's pricing? Is this something that you're concerned about, or would you rather have them adding customers at a more rapid rate like they've been doing? I'd love to hear your comments in the comments section below. Follow Riiv Investing, and we'll see you here next time.